For decades, America's middle class was the engine of the global economy. It was the largest, wealthiest, and most powerful consumer class the world had ever seen. A single income could buy a house, raise a family, and still put something aside for retirement. But something has changed, and the numbers don't lie. In 1971, 61% of American households were classified as middle class. By 2023, that number had fallen to just 51%, according to Pew Research. That's not a small shift. That's tens of millions of families who have either fallen down the economic ladder or, in some cases, climbed above it. But here's what most people miss about this story. The money didn't vanish. It moved. And understanding where it went is the key to understanding what's really happening to the American economy and what it means for your wallet. Let's start where most Americans feel the squeeze first: housing. In 1980, the average American home cost roughly 3 times the median household income. That was considered normal. A couple could save for a few years, make a down payment, and own a home before turning 30. Today, that ratio has more than doubled. A typical home now costs over 7 times the median household income, according to data tracked by long-term trends using the Case-Shiller Home Price Index. In cities like Los Angeles, that ratio climbs above 10 to 1. In Miami, housing costs consume 36% of median income, well above the traditional 30% affordability benchmark. The median monthly cost for American homeowners with a mortgage rose to $2,035 in 2024, up from $1,960 the year before. That's according to the U.S. Census Bureau. And for renters, the picture isn't any better. In major cities, median rents now exceed $2,000 a month. So where did the affordable housing go? It got financialized. What was once shelter became an asset class. Institutional investors, private equity firms, and real estate investment trusts bought up single-family homes at an unprecedented pace, especially after 2008. They turned neighborhoods into portfolios and tenants into revenue streams. The result? A generation locked out of the single most important wealth-building tool in American history.
Now, let's follow the money upward. In the third quarter of 2025, the top 1% of American households owned 31.7% of all U.S. wealth. That's the highest share on record since the Federal Reserve began tracking household wealth in 1989. According to both the Federal Reserve and Bloomberg, the richest 1% now collectively hold approximately $55 trillion in assets. That is roughly equal to the wealth held by the bottom 90% of Americans combined. Let that sink in. 1% holds as much as 90%. This wasn't always the case. In the decades after World War II, wealth was far more evenly distributed. The middle class held a substantial share of the nation's income and assets. But starting in the 1980s, a series of policy shifts, including tax cuts concentrated at the top, deregulation of financial markets, and the decline of organized labor, began redirecting the flow of money upward. And then wages told the rest of the story. Bank of America data from late 2025 shows that higher-income households saw their wages grow at a 3% annual rate. Middle-income households, 1.5%. Lower-income households, just 1.1%. Over years and decades, those small differences compound into an entirely different standard of living. Here's what that looks like in practice. In 1985, an average worker at a major American corporation earned roughly 40 times less than the CEO. Today, that gap has exploded to over 300 times. The productivity of American workers has increased dramatically since the 1970s, but the gains have been captured almost entirely by capital owners, not by the workers themselves. This is the core of the disappearing middle-class story. It's not that the economy stopped growing. It's that the growth stopped being shared.
But there's another dimension to this that rarely gets discussed. The cost of being middle class has skyrocketed, even as incomes have barely moved. Healthcare spending in the United States now exceeds $4 trillion annually. The average family health insurance premium has climbed past $24,000 per year, with employees covering nearly $7,000 of that out of pocket. A single emergency room visit can cost thousands, even with insurance. College tuition has increased over 1,200% since 1980, far outpacing inflation. The average student now graduates with roughly $30,000 in debt. And childcare in many states now costs more than in-state university tuition. Put it all together: housing, healthcare, education, childcare. These four costs alone have consumed virtually all of the income gains the middle class has made over the past 40 years. Wages have technically risen, but purchasing power for the things that actually define a middle-class life has declined. Economists call this the cost disease of the American middle class. You earn more on paper, but you can afford less in practice. And meanwhile, the assets that generate real wealth, stocks, real estate portfolios, private equity, have appreciated at rates far beyond what wages can match. The top 10% of income earners now account for nearly half of all U.S. consumer spending. The economy increasingly runs on their purchases, their investments, and their decisions. This creates a dangerous feedback loop. As the middle class shrinks, the consumer base narrows. As the consumer base narrows, businesses increasingly cater to the wealthy. Luxury brands thrive, while mid-market retailers close. Premium housing developments go up, while affordable units disappear. The economy bifurcates into two tiers, one for those with assets and one for everyone else.
So what can actually be done? History offers some clues. After the Great Depression, the United States made a deliberate choice to build the middle class. The GI Bill, the Federal Housing Administration, massive infrastructure investment, and strong labor protections created the conditions for the most prosperous middle class in human history. It wasn't an accident. It was policy. Some economists argue that similar ambition is needed today. Expanding the Earned Income Tax Credit, investing in affordable housing construction, capping childcare costs, and making community college universally accessible are all proposals currently on the table. Others point to the need for antitrust enforcement to prevent further market concentration, and for tax reform that treats capital gains and wage income more equally. But here's the uncomfortable truth. None of these solutions will matter unless there's broad public understanding of what's actually happened. The middle class didn't disappear because people stopped working hard. It didn't disappear because of immigration or trade alone. It disappeared because the rules of the game changed. And they changed in ways that systematically favored those who already had capital over those who earned a paycheck. This is not a uniquely American story, by the way. The same dynamics are playing out across the developed world, from the United Kingdom to Australia to Canada, where we recently examined the brain drain crisis reshaping their economy. When the middle class hollows out, the entire system becomes fragile. So here's the question this video is really asking. The American middle class was the greatest economic achievement of the 20th century. It wasn't a natural phenomenon. It was built. And right now, it's being unbuilt, piece by piece, policy by policy, quarter by quarter. The money didn't disappear. It just changed hands. And until we're honest about where it went, we can't begin to bring it back. Thanks for watching Through the Money Lens. If this video helped you see the economy differently, consider subscribing. We'll see you in the next one.
There's a dimension to this crisis that gets overlooked in most analyses, and it's generational. The baby boomers, born between 1946 and 1964, accumulated wealth during the most favorable economic conditions in American history. They entered the workforce when a high school diploma could secure a factory job with full benefits. They bought homes when median prices were 2 to 3 times the median income. They invested in stock markets that delivered average annual returns of over 10% for decades. By contrast, millennials and Gen Z have entered an economy defined by student debt, gig work, and asset prices that seem permanently out of reach. A study by the Federal Reserve Bank of St. Louis found that Americans born in the 1980s have accumulated significantly less wealth at the same age compared to earlier generations, and the gap is widening, not narrowing. The home ownership rate among adults under 35 has fallen sharply compared to where baby boomers were at the same age. Those who do manage to buy often stretch themselves to the breaking point, spending well above the recommended 30% of income on housing. This isn't just a personal finance problem, it's a macroeconomic one. When young people can't build equity, they spend less, invest less, and start fewer businesses. The dynamism that once defined the American economy starts to fade. Business formation rates have declined steadily since the 1980s. The rate of Americans moving across state lines for better opportunities has fallen to historic lows. The economy becomes less fluid, less innovative, and more stratified. And the data shows it. Productivity growth in the United States has slowed from an average of over 2% per year in the decades after World War II to roughly 1% in recent years. That slowdown isn't just a number on a chart. It represents the declining ability of the economy to generate broadly shared prosperity.
There is also the question of what happens to a democracy when the middle class collapses. Political scientists have long argued that a strong middle class is the bedrock of democratic stability. When people feel economically secure, they tend to participate constructively in civic life. When they feel squeezed, anxious, and left behind, they become vulnerable to populist promises and extreme political movements. We've seen this play out in real time. Rising economic anxiety has fueled political polarization across the United States. Trust in institutions, from Congress to corporations to the media, has fallen to record lows. And voter behavior has become increasingly driven by economic grievance rather than traditional party loyalty. This pattern is not unique to America. Across Europe, the hollowing out of the middle class has coincided with the rise of populist parties on both the left and the right. In France, the Yellow Vest movement was fundamentally about middle-class economic despair. In the United Kingdom, Brexit was driven in large part by communities that felt left behind by economic globalization. The lesson is clear. When the middle class feels the system no longer works for them, they stop defending the system. And that's when things start to unravel. So where does this leave us? The American middle class is not dead, but it is under more pressure than at any point in modern history. The forces squeezing it, from housing costs to wage stagnation to the concentration of wealth at the top, are structural. They won't reverse on their own. What's needed is what built the middle class in the first place: intentional, sustained investment in the systems that create opportunity for ordinary people. Education, housing, healthcare, infrastructure. These aren't just social programs, they're economic infrastructure. They're the foundation of a consumer economy that works for everyone, not just those at the top. The money is there. $55 trillion at the top. The question is whether the political will exists to redirect even a fraction of it toward rebuilding the broad-based prosperity that once defined America. Because the truth is simple. An economy that only works for the people at the top eventually stops working for everyone. And when the middle class disappears, it takes the American dream with it. Thanks for watching Through the Money Lens. If this helped you see the economy differently, subscribe. We'll see you in the next one.